So this is question number 1 on homework 8 for module 11. And this is a sort of a typical question about forecasting income statement and balance sheet. So we're provided with the current income statement of this company, Best Buy, and also the balance sheet. We also provided a bunch of assumptions which we can use when we forecast for the next period income statement and balance sheet. So these are the assumptions which we can use for forecasting the income statement, and these are the assumptions which we can use to forecast the balance sheet. And we also need to be careful in reading the setup, especially the rounding requirement. Round all your answers to the nearest whole number, and do not use negative signs with your answers in the income statement. And also in terms of the assumptions which we can use for the forecasting, it also mentions that assume no change for accounts not listed. All right, so as a starting point, we can just first copy the current income statement and the balance sheet to Excel. So just paste it, paste the special text. So this way we don't have to manually input the numbers. We can just work on these numbers directly. And we can also do that for the balance sheet. Also copy just below it, and the reason will become clear very soon. So as a convention, we can, even though the financial statements list the most recent numbers to the left, but just for the convenience of putting the numbers for the forecasting statement, we can actually copy the most recent number to the right. And what I will do here is to copy the earlier year's numbers to the left. So I think the reason is clear now why I copied both income statement and the balance sheet together, because now I can just copy them both earlier years numbers just in one copy. So now I can insert cut sales, and then so my job is to forecast 2012 number here, right, for both income statement and balance sheet. So we can also copy the assumptions which we can use in order to do the forecasting. So, and let me put the assumptions here. It's sort of a very sometimes not very so long words, which I can adjust the length for each column. And likewise, I can copy the assumptions which we can use to do the balance sheet forecasting. So to the right of the balance sheet. Special. All right, so now we can start. And of course, as we talk about in this module, in terms of the forecasting, we should start from income statement, particularly sales, right? That's like the engine for the whole process. So because the revenue growth is assumed to be this number, 6%, so we can just use the current sales times 1 plus this 6%. And I want to use the round function of Excel because as I earlier read that this setup requires us to round to the whole number. So I just round to 0 decimal place. And so that's it for the revenue forecasted number. And cost of goods sold, it's assumed to be as a percent of revenue as a convention. All right, so we can just use the forecasted revenue and then times this percent. And then still I'm going to use the round function and to 0 decimal place. So then the next item is the restructuring charges, cost of goods sold. And if you look at the assumption, it doesn't have any number, so we can assume that that's 0. So that means last year's charge was a one-time charge. So gross profit is basically the difference between the sales and cost of goods sold, and then this 0. And selling, general, and administrative expenses, this we have also generally is assumed to be as a percent of sales. So we can use that information. So we multiply by the current sales. And again, I want to put a round to 0 decimal place. Restructuring charges, and this also doesn't have any information, so we just leave it as a 0. Goodwill and trade name impairment. So this also has no change, so it's 0. Operating income basically is just the difference between gross profit and the sum of these three items here. All right. Basically, because these two are 0, so it's just the SGA basically. And other income. So other income, if you look at actually, if you go back and look at the blanks here, other income actually, in this case, is blocked. So which means that we don't have to worry about this item here. And then investment income and other. So this is assumed to be 51, right, which is the same as last year's number. And interest expense. So in general, we as we illustrated in one of the videos, to replicate the example of forecasting in the textbook for the Procter and Gamble. There, we used the average debt balance to multiply that average balance by the interest rate, and we used the interest expense and divided by the earlier year's average debt balance to estimate the interest rate. So that's like a more complicated process than what we need to do here, because in this case, interest expense actually is directly provided. It's assumed to be the same as last year's number. So we can just put that number here. So hence earnings before income tax expense. So this is basically the operating income, and then we should add the investment income, and then we deduct the interest expense. And the reason why we don't have a differentiation in terms of the signs on the income versus expense is because if you go back to the question, it says that do not use negative signs with your answers in the income statement. And that's also true for the balance sheet. So whether it's expense or income here, we should always put a positive number. So that means we should remember whether it's expense or income, hence we should use the right sign when we want to calculate some of the items, such as the earnings before income tax expense here. And income tax expense. So income tax expense here is assumed to be this. So that means the tax rate is about 34.40%. So we can just directly apply that to this earnings before income taxes. So again, I want to round this number to 0 decimal place. So equity income of affiliates, this is again assumed to be just the same as last year's number. So now net earnings, including non-controlling interest, is simply the sum of the after-tax earnings and this equity in income of affiliates. So to get the after-tax income, we just need to subtract the income tax expense from the earnings before income tax expense. So that minus that, and then we need to add these two. So that's my net earnings including non-controlling interest, and then net earnings attributable to non-controlling interest. Here we do need to pay attention. Net earnings attributable to non-controlling interest divided by net earnings including non-controlling interest is a fraction, right? Here we assume it's 6.50%. So we can use that information for this. So basically it's net earnings including non-controlling interest and then times this fraction. So that's basically gives us the number. So and then we will also use the round function. And net earnings attributable to Best Buy, basically the parent company. That's the net earnings including non-controlling interest, and then minus the net earnings attributable to non-controlling interest. Right, so basically we are done with the forecasting of the income statement. And now let's get to the balance sheet. So the first item is cash, but actually we'll leave the forecasting of cash to the last step because cash is what we call the plug variable, which is used to balance the balance sheet. So we just keep that blank for now. Short-term investments, going back to the assumptions for forecasting the balance sheet, short-term investment is there's no change. So we can just keep it same as last year's amount. And receivables, and this amount generally working capital amounts, right? Working capital items, they are assumed to grow with sales. So we can see that from these numbers here actually. So that equals the forecasted sales and then times this percent. So now I want to do two things. First, I actually want to fix the sale of the forecasted sales. The reason I want to do that is because later on I want to actually pull the sales down because many of the items below these receivables will also grow with sales. So that way I can just directly pull the sales and then the numbers, of course, on this assumptions table here, the item sequence of the item has to match the sequence of the item on the balance sheet. And so that's the number one adjustment I want to do. Second one, of course, is to put a round function around it. Just keep 0 decimal place. So this is my receivables. So as I said, merchandise inventories, you can see that that's also is a percent of revenue. So now since I have done the work which is needed for the sales, now I can just directly pull the sales. So other current assets, you can see that's also a percent of revenue. So I can also actually do this for the other current assets. And total current assets, I don't know this number because I don't know the cash yet, but I can leave this blank. We'll come back to this item later. And now let's get to the property and equipment section. Um, Here it listed land, buildings, leasehold improvements, fixtures, and equipment, property under capital lease, gross property and equipment, less accumulated depreciation, and hence that's net PPE. So basically, this gross PPE is the sum of the many items above this item. And if you go back to the balance sheet, the blanks actually, we don't have the space to for these components of this PE, right? We only have the gross PE and net PE. So that means we don't have to worry about forecasting the land, buildings, those items. We just have to worry about their aggregate, the gross PE. So in terms of the gross PE, we know that this is, you can see that there's no direct information about gross PE, but we should know the relationship between PPE and capital expenditure and the depreciation, right? So in terms of the gross PE, because on the balance sheet, every item is cumulative, right? So the gross PE for the next year, it basically is the current gross PE and then plus the new capital expenditure, right? Because capital expenditure here, you can see that it's used to the increase in gross PE. So capital expenditure is further a fraction or percent of revenue. So we can use that information here. So it's going to be in the new revenue and then times this fraction. And then we can put a round function around this, round to the whole dollar. So that's the new gross PE. And accumulated depreciation, that's where we need to be a little bit careful. Basically, accumulated depreciation is the last year, right? It's the last year's depreciation, accumulated depreciation, plus this year's new depreciation expense. That's basically their relationship. So then our job is to find where is the depreciation expense, right? Where is the new depreciation expense? And that information you can find actually here, right? Which I will highlight this in yellow. Depreciation divided by prior year gross PPE is assumed to be 12%. So we can use that information here. So accumulated depreciation is basically the current accumulated depreciation and then plus this new depreciation expense. And new depreciation expense is further equals prior year gross PPE, right? Prior year gross PPE is right here. And then times the fraction here. And then I want to round this to the whole dollar. So that's my new accumulated depreciation. Now their difference becomes net PPE, right? It's gross PPE minus accumulated depreciation, and that becomes net PE. And goodwill. So now let's get to the goodwill. Goodwill is assumed there's no change, so we can just use the same amount as last year's. And trade names net. You can see that trade names does have amortization. In general, goodwill doesn't have amortization. There might be an impairment charge, but it doesn't have amortization. And trade names has amortization, which is equal to 25. So we can use that information to get the new trade names net, which is the current net trade names, and then minus this amortization for trade names. So the same is true for the customer relationship. There's also amortization expense for that. So so the new net customer relationships is basically the current level of the net customer relationships minus the amortization expense for customer relationships. So it's basically the same relationship as the twin names. So we can just pull the sales down and it will automatically calculate the new customer relationships. And equity and other investments. Equity and other investments, there's no change. So we just put the same amount as last year's. And other assets is assumed to be a percent of revenue. So we can use that information that equals the new revenue and then times this percent other assets here. And again, I want to use the round function to round this to the whole dollar. So total assets, because we can't calculate the current assets, hence we also can't calculate the total assets, but we can leave that blank for now. And with the knowledge that total assets has to balance the total liabilities and the shareholders' equity, right? That's the accounting equation we need to keep in mind. So now let's get to the liabilities and equity section of the balance sheet. So the first item is accounts payable. Accounts payable, let's go back to the assumption table here. Accounts payable is also a sort of a percent of sales. So it's equals the new sales. It's right here. And then I think I have to make sure, yes, it's D3. I think it's D3. Yeah, just make sure sometimes if I do this very quickly, might not give me the desired result. Yeah, I have to make sure about that. Yes. All right, so accounts payable. Getting back to accounts payable, it's the new sales. It's right here. And then times this percent, right, accounts payable. Right here. Again, use the round function and to the whole dollar. Okay. So unredeemed gift card liabilities. This actually you can see a lot of the items here are as a fraction of the revenue. That's why here I also want to do a trick of adding the dollar to fix the sale. So now I can I have to make sure the sequence of these items matches the sequence of the items here. So you can see that seems to be the case, right? Accounts payable followed by unredeemed gift card liabilities, and accrued compensation, accrued liabilities, and accrued income taxes. Yeah, all these items can be automatically calculated because they are a fraction of the sales. So, and then short-term debt. Short-term debt is basically, you can see that there's no such information available on the assumption table. So what does that mean? And I think it means that if you go back to the setup, it says something which we can find to be useful. Assume that all actually assume no change, right? Assume no change for accounts not listed. So that this might be one of the examples, right? Short-term debt. So we just assume this to be the same amount as last year's. And current portion of long-term debt. So this it's a bit tricky here because this refers to the portion of the long-term debt that will become due in the next year. So after 1 year, the total amount here for 441 will become due. So this part is gone. So for the next year, it's going to be the new long-term debt, new portion of the long-term debt, which will become due actually 2 years from today, right? Because we are doing the forecasting for the next year. So 2 years from today, when we stand for the next year, it's going to be due 1 year from next year. So then we look for the information here. We found that the last item, which I will highlight in yellow, long-term debt payments required in fiscal 2013. Right, that's exactly the number we need because we are trying to forecast the number for 2012. So 2013 is like the next year, and this will become due in 2013, which is 1 year from 2012. So this part actually is the current portion of long-term debt. So we can just use this information here, 37. And hence total current liabilities is basically the sum of all these numbers here, all these numbers. And long-term liabilities, going back to the long-term liabilities, you can see there's no change, right? So we can just assume this is the same amount as the current amount. And long-term debt, this is also part which we need to be super careful. Even though it's not mentioned in this table, but we need to realize there is a relationship between the next period long-term debt and this period long-term debt, right? Basically, the long-term debt will because the current by next period, its current portion, which is actually this 37 here, will be put into the current portion of the long-term debt. So the long-term debt will further decrease by this current portion of the long-term debt for the next period. So the new long-term debt will be the current long-term debt and then minus this current portion of the long-term debt for the next period. So this is the new level. And now, so we are done with the liability side of the balance sheet. And for the equity side, preferred stock, I guess there's no such information available, so we can assume this is 0. And common stock, if you look at the assumption table, you also cannot find any information about that. So we can also assume this to be the same as last year's, which basically means that the firm doesn't plan to issue any new equity, right? Because remember, this is cumulative amount. Any item on the balance sheet refers to the cumulative amount. So being the same means that the firm doesn't plan to sell any new stocks in that particular year. Additional paid-in capital, there's also no such information available on the assumption table. So we can also assume this to be the same as last year's amount. And the retained earnings here, we need to be super careful because can't find information about that on this assumption table, but then again, we need to realize there is a relationship between next period retained earnings and this period retained earnings and the addition to retained earnings, right? Addition to retained earnings basically is net income minus the dividend. So that's why here you can see that the dividend information is provided. I guess that's from that information we can, which I will also highlight this in yellow. Dividends as a fraction of net income is provided. And from there, we can calculate the forecasted dividend. And we also know the forecasted net income, right, from the income statement here. So from those two numbers, we can get the addition to retained earnings. Hence, we can get the new retained earnings, which is the sum of the current level of the retained earnings and that addition to forecasted addition to retained earnings. All right, so this equals current retained earnings plus the forecasted net income, right, from the income statement, and then minus forecasted dividend, right? And then forecasted dividend further is the net income, for forecasted net income multiplied by this 18.60%, right? So it's going to be this amount. Round this to 0 decimal place. All right, so that's retained earnings. And And then accumulated other comprehensive income, there's no such information available, I guess, on this assumption table. So we can also assume this to be the same as last year's amount. And total Best Buy shareholders' equity, basically this is the sum of all these items here, right? All these items here. So non-controlling interest, you can see the assumption here, non-controlling interest, which I will highlight here in yellow as well. So there's a star, and you read the star, it says increase by net income attributable to non-controlling interest and assume no dividend. So basically means that the non-controlling interest will increase by, something on the income statement, which is net earnings attributable to non-controlling interest. So this is 105 here. So that's the new non-controlling interest. Now the total equity is basically the sum of this total Best Buy Co's shareholders equity and this non-controlling interest. Right. So now the total liabilities and shareholders equity basically is sum of the liabilities and shareholders equity. And sum of the liabilities basically is the total current liabilities and plus long-term liabilities and plus long-term debt, and then finally plus the total equity. So now we have this number, and because total assets, now we can go back to the asset side, right? Total assets has to balance with the total liabilities and equity. So the total assets has to be the same as the liabilities and equity. And from this total assets, now we can back up the total current assets, right? Basically is the total assets minus the non-current assets. And non-current assets basically is the sum of these items here. So, and then we need to be a little bit careful because we need to add net PPE, right, rather than gross PPE. So we can start from net PE and then add all these long-term asset items. So that gives us the total current assets. So now finally, we can back out the cash by deducting other current assets from the total current assets. So it's going to be total current assets minus the sum of all these other current assets items. So that gives us the cash. I guess we are pretty much done with the forecasting. I think the rest of the job is to simply to copy the numbers back to its appropriate place on MBC. So let me do that. First, revenue, right? Make sure we put it in the right place. To save you some time, I have saved the time for me to copy and paste all the numbers. You can see that I have already copied all the numbers back to MBC. So we're done with the forecasting part of the question. For part B, what does the forecasted adjustment to balance the accounting equation? So that's basically referring to the cash. Right, from part A, review to us about the forecasted cash balance and related financing needs of the company. If you read the choices here, basically it's saying that whether the cash is sufficient or not sufficient. So what does the sufficiency here mean? I think in the module we talk about sufficiency basically is by comparing the forecasted cash balance, which is the item here, with what we call the normal cash balance. And then how do we calculate the normal cash balance? That's basically by assuming that the cash balance will stay as a constant percent of the sales. So we can get the normal level by first calculate that fraction, right? The current fraction of the cash to sales is we can calculate that amount here. So that gives the current percent of cash to sales. So that serves as the normal percent, and then we can multiply by the new forecasted sales, and then we can round that also to no decimal place. So you can see that the forecasted cash balance is higher than this, what we call the normal cash balance, right? And from that information, we can see which answer actually matches that statistic. Best Buy will generate sufficient cash for the coming year. This is true. The cash balance decreases fairly significantly. And this doesn't make any sense, right? Cash balance actually increases relative to the normal level. Best Buy will generate sufficient cash for the coming year. The cash balance increases fairly significantly, which is true. We could adjust the marketable securities, leaving total assets unchanged. This is also true. We talk about if the firm has more than sufficient cash and more than the normal level of the cash, it can actually use the extra cash to do some things like increase in the capital expenditure and buying more securities, such as doing the investment in the stock market, right? You can use that extra cash. Hence, the cash balance will fall to its normal level, and hence some of the other items on the balance sheet, such as marketable securities, might increase. Right, so this is actually true. We can choose this one. And if you continue to read other choices here, you can see that the last two choices doesn't match our cash balance amount, right? So now we can check our answer. I guess we have done this question correctly.